Some high-level things on Johnson & Johnson. Oh my God, look at this. Very boring company.
Extremely boring company.
Hey, now you got to turn into cyclicals and you got to start buying conservative cyclicals. Johnson & Johnson stock, is it a buy? Guys, nothing irritates me more than when I see some idiot on Market Watch or some other major publication talk about, hey, now you got to turn into cyclicals and you got to start buying conservative cyclicals. They never mention price versus value. Why is that, Mo Hussein?
Because it doesn't matter to most people.
It doesn't matter to most people. They see a stock at $100. All I think about is, I want to own the stock and I can afford it by buying 1 or 2 shares at $100 each. Great. Guys, the stock price is a complete manipulation. Look at it this way. Apple is worth 2 or 3 times more than Berkshire Hathaway. Apple's stock price is $145. Berkshire Hathaway is over $400,000 per share. It's not about the price per share. If this is the first time you're hearing this, you need to do yourself a favor. You need to subscribe to the channel because you're going to learn a ton more. That's the first thing. Mo and I, our goal is to separate the stock from the company. We want to buy great companies, but more importantly, we then need to buy them at a good price. We need to buy them at a price that gets us a good return on our money, right? Mm-hmm. Johnson & Johnson, very boring company.
Extremely boring company.
Right? They got all their everyday products for the family. We're opening up in our software right now. $443 billion company. So prime example there, $443 billion. The stock price is $162. Berkshire Hathaway is $677 billion company. So 50% more. Stock price is $461,000. It's not about the stock price. It's about what that stock is buying you. It's about the market cap of the business. All right. Some high level things on Johnson & Johnson. Oh my God, look at this. Look at this chart. It's just up in that business. First off, $443 billion market cap, enterprise value 532. This is something that you're going to see me mention on pretty much every video about individual stocks. This difference is essentially their net debt, the debt minus their cash on hand. So if you wanted to buy the entire company with no debt on it, you basically have to pay $532 billion. All right, Mo, what are the other things that jump out at you here?
I just went to the 8 pillars and I looked at ROIC, 12.9%.
Boom.
Love it. 5-year ROIC.
We want a high return on invested capital. This means the company has to spend less money to increase their earnings. The higher and higher the return on invested capital, the less money they need to invest to increase earnings. That's the big key. If their return on invested capital is south of 6 or 7%, they're not good allocators of their capital. They're losing money for their investors every time they go out there and try to make more money. Mm-hmm. So this is a solid ROIC. Now, by the way, you'll be wanting to pay a higher PE and a higher price of free cash flow for high ROIC businesses. There are a lot of value investors out there who want 15% or more. All right. The 1 year is 14%. I'm okay with a company like Johnson & Johnson if I can buy it at the right price. 12.9 is great. Mm-hmm. Dividend. Nice dividend here. 2.7. Yeah. The market's like 1.6.
This is a lot of why you see a lot of those big headlines on Market Watch and saying, hey, you got to buy Johnson & Johnson.
Oh, because of dividend. Now remember, guys, just because they pay a good dividend does not mean they can afford it. This is why on our software, we have the dividends paid here, $11.5 billion. And right above it, we have the last 12 months, trailing 12 months, and the 5-year average free cash flow. $11.5 billion. And their 5-year free cash flow is 19.34. An ideal world, I want to pay less than, I want to see dividends paid less than half. However, Johnson & Johnson's a very, very large company. Yeah. My guess is their ability to reinvest at high rates of return is probably very limited. So I'm okay with a little bit higher dividend. Profit margin, gross margin, very high, 67%. Wow. Bottom line, boom.
Yeah, wow.
All right. So let's go take a look at our 8 pillars like Mo already did. All right, this 5-year free cash flow, I'm not worried about this. A drop of $730 million. We saw it here that there was a drop. Let's go check it out and see why that is. Mo, do you want to check it out? Oh, you're actually doing something else.
I'm actually looking at their pipeline.
Oh, great. So this is the big difference here. Big change in working capital, minus $4 billion. And that's why their free cash flow was increasing and now it's down. So I'm not worried about that so much. So back to the 8 pillars. Not buying back a ton of shares, which I'm okay with because the stock seems a little hefty at a 5-year PE of 31 and a 5-year price to free cash flow at 23. Like I said, high return on invested capital. Okay, all around, none of these things like scare me.
Yeah, nothing's shutting it down for me yet.
Now, I can already tell I probably want it cheaper than these two numbers give, but that's okay. Let's figure it out. Let's see what analysts are saying about the company. And in our software, we get 22 analysts for this year. Ooh, look at this EPS growth. Very limited.
Look at the revenue growth.
10.5 to 11.7 over the next 3 years. Low single digits. Guys, they're going to spend a lot of money giving it back to investors. When the stock becomes cheaper and cheaper and cheaper, they're going to buy back more shares. They're going to pay out more dividends. So it's going to drive up earnings per share when they buy back more shares. That means less and less partners for you as an owner. Let's say you work at a company, you own a company and there's 10 partners. If all of a sudden the company starts buying out partners and they take out 3 of them, they're down to 7. Now, instead of owning 10% of the business, you own 14.5% of the business. That's what they're going to be doing there. And the revenue was just abysmal. Yeah. Now, I will say this though, Mo. I don't agree with this revenue. I think revenue growth should be at least inflation, especially for a company like Johnson & Johnson. They got to grow with inflation, right?
Yeah. I don't see why they wouldn't. I don't think that, this is basically zero revenue growth. I don't necessarily see that.
And
I'm already thinking of what I would put in Stock Analyzer tool, and it's not zero.
Correct. And a lot of value investors will say that the long-term growth, especially for an international company like this, should be 6 or 7% a year over long periods of time. Because as the world becomes wealthier and wealthier, they're going to sell more and more products to those people.
Right.
All right?
Think about all of the stuff that is probably just in this building that's Johnson & Johnson that we don't even know about.
Oh, yeah, you're right.
They're everywhere. You probably have so many products in your home that are J&J and you don't know it.
What's their pipeline?
It's very solid pipeline. I just pulled up their drugs in phase 3 right now. They are in every different arena, and it's good arenas. Cardiovascular, immunology. They're really big in the oncology world where both of our dads are in. And a lot of these drugs I've already heard about, and I've read that they're working with other companies on different types of combination therapies and whatnot. It's good drugs, really good drugs.
All right. So far, guys, we're looking at Johnson & Johnson and we're saying we like what we see from a qualitative perspective. Very high level qualitative, but qualitative nonetheless. From the numbers perspective, from quantitative, the only thing I look at is that multiple of earnings and free cash flow. So the question becomes, what should I pay for the company? So next, we're going to use our Stock Analyzer tool. This is the piece of our software that was used over 1.3 million times last year by our users. Now, if you noticed, this video had no YouTube ads. The reason being is we want to focus on the content and we want to focus on our software. So watch this next little piece about our software. Check it out. I created the software that you're seeing on the video and behind me because I needed software for myself. This is not something that was created for other people and I use some super exclusive, expensive software. This is the software I use. And even better, we have this community of thousands of people there. And the reason it's so helpful is it allows us to eliminate the emotional fear that makes people make the bad decision investing. The right investing is 20% about the numbers and 80 or 90% about your temperament and emotion. And that's why it's awesome to have this community. The tools help you on the numbers. The community helps you on how to view your investments and your money. So stop making those terrible decisions that all your idiot friends make when they follow companies just because they like the company. For a little over $1 a day, you can have this entire software package. It'll change your entire future of investing and your money. So sign up now, risk-free, everythingmoney.com. Check it out. All right, guys. So join that community. Now, I'm going to do a 20-year analysis on Johnson & Johnson. Mo's going to do 10. The reason I'm doing 20 years is Johnson & Johnson's the kind of company where if I buy it for the right price, I want to own it for a very long period of time, especially with that return on invested capital being so high. Yeah. Okay. So look at the 5-year, 10-year, look at these growth numbers. What is this in line with? Inflation. And I do think that's going to, okay. So Mo, you do your numbers. I'll do mine. And I'm going to do low for like a minimum, a middle, and a high profit margin. Okay.
Yeah.
This is a little bit harder, but we'll see.
Let's see how that goes.
Okay. So the guys, remember one thing. This is all about making our assumptions. Every investment's the present value of all future cash flow. This Stock Analyzer tool doesn't look at the balance sheet. It just says, okay, this future stream of cash flow, what do you expect it to do? And cash flow is a factor of revenue and profit margin and free cash flow margin. And at the end, how much is the company going to sell for? What kind of multiple are we going to sell it at? All right. What's the market going to dictate? So Mo, on your 10-year analysis, why don't you go through and tell everybody why I finished mine up?
So revenue growth, I did 2, 4, and 6. Profit margin, 16, 18, and 20. Free cash flow margin, I went a little bit higher, 17, 19, and 21. PE, 13, 15, 17, same for price to free cash flow. And my return, I went with 12, 13, and 14.
Okay, so I went a little bit different
Okay.
On my revenue growth for 20 years, I did 3, 4, and 5.
Okay.
Profit margin, I did 15, 17, 19. I went really low on this 15. Free cash flow margin, I did 19, 21, and 23, which is also pretty low. PE, I went 15, 16, 17 because of the brand name, the moat, and the return on invested capital. Same with the price of free cash flow. Now, I think I'm going to change this one. I think I'm going to do 10, 13, and 16 for my desired return. Okay. Now, guys, if you've watched our channel before, I used to always do 12% here.
I actually agree with 10.
But again, I think I beat this up quite a bit here. I did
margin of 15.
Yeah, I beat this up. So if I could buy this I think this already has margin of safety in here. Right. So why do double? Right. This is essentially your margin of safety, guys. The higher you put desired return, the more margin of safety you have. Now, the stock's at 162. I'm hitting the analyze button. 6 numbers are going to pop up. Low, middle, and high based on earnings, and low, middle, and high based on free cash flow. If it comes up all green, doesn't mean go out and buy. It means go do your due diligence. As you saw in that video, join the community. Thousands of people you can talk to about Johnson & Johnson. If it's all red, don't just cry and scream and throw something. Add it to your watch list because you want to. That's the great thing about the software. You can sit there and keep adding stocks to your watch list and get notified. I have over 100 stocks on my watch list waiting for me to get notified. So, Mo, what were your results?
I have 65 to 69 on the low end, 108 to 114 on the middle and on the high end, and the middle ground's about 85 to 90.
And this is the point of art of investing. I have 80 to 100. High side's actually lower, 70 to 90, because I have such a high desired return. Middle side of 75 to 90. So I'm looking at this going, I'm adding it to my watch list at 100. And the reason being, does that mean I want to buy it at 100? Not necessarily. But what that means at that time is I'm going to take a look at it and start selling puts at a lower price. And it actually makes sense with such a high PE, 22, to drop 30 or 40% would take us almost there. And I want a higher return in the market. Makes sense. So guys, thank you very much for your time.